banking, bonds, Battlestar, Federal Reserve.
What are you doing?
Michael! Your mortgage rate, your retirement savings, all affected by decisions made inside this building, the Federal Reserve, America's central bank. Arguably the most powerful economic institution in the world. And right now, its independence is under threat. Since its creation in 1913, the Federal Reserve has evolved into America's economic guardian. It controls the nation's monetary policy, supervises banks, maintains financial stability, and provides financial services to institutions. But most Americans don't understand how it works, or why its independence matters. Recent statements from President Trump have renewed concerns about political interference with the Fed. He suggested he wants to fire Jerome Powell, the current chair of the Federal Reserve. This isn't just Washington drama. It's a fundamental threat to economic stability that could affect everything from your grocery bills to your job security. And this is very serious. Oh, I'm getting a call. Huh. CNN. That's weird. Hello? Who is this? Oh, hi. Hi, Kate. Doing good. Oh, has he? Wow. Yeah, I'm not surprised. Huh. Okay. Okay, thank you. Bye. Yeah, apparently I just got news from CNN. Breaking news. In a stunning development that surprised absolutely no one, President Trump walked back on those statements. Trump is now saying Powell has done a great job and that he no longer plans to replace him. Wow, this is so unlike him. It's all part of the art of the retreat, right? This reversal is interesting, maybe not that surprising anymore, but it doesn't change the fundamental question at the heart of this video. Should presidents have the power to fire Fed chairs when they disagree with monetary policy decisions? And what does history tell us about political interference with central banks? The answers might surprise you, and they matter more than you think. But let's start with the current situation. President Trump has made it clear he's unhappy with Jerome and the Federal Reserve's interest rate policies.
On Jerome Powell, you said that the termination of Jerome Powell cannot come fast enough. He says he won't leave, even if you ask him to. Do you believe you have...
If I ask him to, he'll be out of there. But
do you believe you have the power to remove him? And are you trying to do that?
I don't think he's doing the job. He's too late, always too late, a little slow, and I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast, believe me.
This isn't new territory for Trump. Even during his first term, when he nominated Powell back in 2017, he quickly soured on his pick when Powell didn't keep rates as low as Trump wanted. During his first term, Trump called Powell clueless, a bonehead, and compared him to a golfer who can't putt. The last one was uncalled for, we all agree. But fast forward to 2024, and Trump's campaign rhetoric initially suggested he would replace Powell if elected. But recently, Trump changed course, praising Powell for bringing down inflation and suggesting he would keep him in place.
Now, President Trump has spent days attacking the chairman of the Federal Reserve, saying that his termination could not come fast enough, and just yesterday calling him a, quote, major loser, and then today saying this.
No, I have no intention of firing him.
This reversal might reflect political calculation rather than a newfound appreciation for central bank independence. But regardless of the motivation, it highlights a crucial point. The relationship between presidents and Fed chairs has always been complex and sometimes tense. And there's a good reason for that tension. Fed independence isn't an accident. It's a deliberate design feature of our economic system. The law establishes that Fed governors, including the chair, can only be removed for cause, meaning provable incompetence or legal misconduct, not policy disagreements. This protection exists precisely to shield the Fed from the kind of political pressure that we're seeing right now. For a guy famous for saying,
"You're fired. You're fired. You're fired. You're fired. You're fired."
I was wondering what you would say to President Obama.
You're fired.
Trump sure is frustrated that he can't simply dismiss the Fed chair at will. And there's a good reason for that limitation. Maintaining artificially low rates for too long could have dire consequences. And here's the thing, Powell's job isn't to help any president look good. It's to maintain inflation under control and maximize employment for the long-term health of the economy. Now, Trump's desire for low interest rates reflects a fundamental misunderstanding, or perhaps disregard, for how monetary policy works. Low rates can stimulate economic growth in the short term, which looks great for a president seeking re-election, or in his case, kingship. You see, this would be the financial equivalent of letting your kids have ice cream for every meal. Sure, it feels great at first. The economy gets a sugar rush, stocks go up, everyone's happy, until the inevitable crash and economic diabetes sets in. Okay, so how did the Federal Reserve become independent, and why should it remain so? History time. The Federal Reserve System, the central banking system of the US, was created in 1913 with the signing of the Federal Reserve Act by President Woodrow Wilson. But its modern independence wasn't fully established until 1951 with the Treasury Federal Reserve Accord. The accord was signed in response to growing tensions between the US Treasury and the Federal Reserve regarding interest rate policy and the control of US monetary policy. During World War II, the Fed had essentially surrendered its independence, keeping interest rates artificially low to help the government finance the war. The Fed wanted to move away from low interest rates afterwards so it could combat inflation. However, the Treasury, concerned about the market for government securities and the cost of borrowing, urged the Fed to maintain the low rates. The result? Once the war ended, inflation surged to nearly 20%. Politicians focused on election cycles naturally favor policies that deliver short-term gains, even at the expense of long-term stability. That's precisely why Fed governors serve 14-year terms to transcend these political cycles. And that's how the Fed became independent. But why should it remain so? Well, there are 5 main reasons. First, preventing short-term political manipulation. Politicians face election cycles every 2 to 4 years in the US, and their primary incentive is getting re-elected, which creates a powerful temptation to juice the economy before elections, even if it causes serious damage later. Imagine you're a president facing re-election. Cutting interest rates could create a short-term economic boom just in time for voters to cast their ballots. The inflation and economic instability that follows, that's a problem for after the election. This isn't theoretical. In 1970s, President Nixon pressured Fed Chair Arthur Burns to keep interest rates artificially low before the 1972 election. Nixon, of course, won in a landslide, but the economy soon suffered from runaway inflation that took a decade to fix. Second, combating inflation often requires unpopular decisions. Fighting inflation means raising interest rates, which slows economic growth and can increase unemployment in the short term. These are politically painful choices that elected officials naturally avoid. An independent Fed can make these difficult but necessary decisions without the fear of political reprisal. When Paul Volcker dramatically raised interest rates in the early 80s to break the back of inflation, it triggered a painful recession. Had he been under direct political control, he would likely have been fired before completing this essential but unpopular task. Third, market confidence and economic stability. Financial markets and investors require confidence that monetary policy won't change with political winds. When markets believe the Fed might be forced to serve political interests rather than economic ones, it creates uncertainty and volatility. This isn't just about investors. Market instability can affect retirement savings, home values, and job security. Independent central banks give markets confidence that decisions are being made on economic merit, data, and not political expedience. Fourth, international economic credibility. The dollar's status as the world's reserve currency depends partly on global confidence in America's monetary institutions. When other countries perceive that our central bank might be politically compromised, they may reduce their holdings of dollar-denominated assets. This international dimension is often overlooked, but it's crucial for America's economic power and the favorable borrowing terms we enjoy globally. Fifth, long-term economic planning. Economic stability requires consistent, predictable policy over extended time frames. The Fed's leadership structure, with 14-year terms for governors specifically designed to span multiple presidencies, allows for long-term economic planning beyond political cycles. These 5 reasons, preventing political manipulation, making tough anti-inflationary choices, maintaining market confidence, preserving international credibility, and enabling long-term planning, are why central bank independence is considered essential by economists across the political spectrum. The Federal Reserve's independence wasn't established overnight, and most importantly, it wasn't arbitrary. It was a direct response to the economic turmoil that resulted when monetary policy was subordinated to political goals. And not only that, several studies have found that having an independent central bank drives better price stability. But hold on a sec. While the Fed is independent in its decision-making, it is still accountable to Congress. Fed officials, including the chair, testify before Congress regularly, and the Fed provides reports on its actions and the economic outlook. Congress also established the Fed's goals, like maximum employment and stable prices, and could change the laws governing the Fed if it chose to. However, the day-to-day decisions on how to achieve those goals are deliberately kept separate from political influence. Okay, those are all good reasons, but you may be wondering, are there real-life examples of countries that have meddled with their central banks? And to that I'd say, why, good sir, of course. History offers plenty of cautionary tales. Let me introduce you to Exhibit A, Argentina, a country that was once among the world's wealthiest economies. Argentina has a long, sad history of government interference with its central bank. Presidents have fired central bank governors who didn't follow political orders, forced them to print money to fund government spending, and basically treated monetary policy like their personal ATM. The result? Catastrophic. In 2024 alone, inflation in Argentina reached nearly 230%. Let that sink in. Imagine your groceries costing $300 and $990 the following year. That's not a price increase, that's a financial crime scene. For decades, Argentine presidents have treated their central bank as an extension of the treasury, forcing it to print money to fund government spending and firing central bankers who oppose these policies. But Argentina isn't alone. Venezuela, Zimbabwe, and Turkey have all seen political leaders meddle with their central banks, resulting in economic problems. In Turkey, President Erdogan has repeatedly fired central bank chiefs who wouldn't comply with his unorthodox economic theories. Between 2019 and 2021, he cycled through 4 different central bank governors. And guess what happened? Inflation skyrocketed to over 85% in 2022. And then there's the extreme case of Venezuela, where government control of the central bank led to hyperinflation, reaching over 63,000 in 2018. It's so high that it creates this bizarre chart. These aren't just abstract economic stories, they represent real human suffering. jobs lost, savings wiped out, retirements delayed or destroyed, lives upended. So why should you care about central bank independence? Because the Federal Reserve's decisions affect virtually every aspect of your financial life. When inflation runs too high, your purchasing power erodes. A dollar today buys 20% less than it did just 5 years ago. That's why the Fed's commitment to price stability matters. When recessions hit, the Fed's ability to quickly respond and effectively, without political interference, can mean the difference between a brief downturn and a prolonged depression. Your mortgage rate, auto loan, credit card interest, and retirement account performance all connect directly to Fed policy. An independent Fed focused on long-term stability rather than political expediency provides the foundation for sustainable prosperity. With an independent Fed, decisions are made on economic data and long-term stability, not electoral calendars. This means more stable prices, more predictable interest rates, steadier job growth, and ultimately, greater economic security for everyday Americans. So, where does this leave us today? Trump's reversal on Powell might suggest the immediate threat to the Fed's independence has receded, but the underlying issue remains. Our system relies heavily on norms and political restraint when it comes to respecting central bank independence. Look, the Federal Reserve isn't perfect. Reasonable people can disagree with specific decisions Powell has made, but threatening the independence of the institution itself? Nah, no thanks. So the next time you hear someone say they want to bring the Fed under control, remember, what they are really saying is that they want to trade your long-term economic stability for their short-term political gain. And historically, that's a trade that ends with people using wheelbarrows of cash to buy bread. Throughout history, presidents from both parties have often disagreed with Fed policy, but respected its independence. Paul Volcker famously raised interest rates to unprecedented levels to tame inflation in the early 80s, a move that contributed to a painful recession, but ultimately set the stage for decades of stable growth. President Reagan, despite the political cost, supported Volcker's independence. The fact that firing a Fed chair over policy disagreement is even discussed shows how fragile these norms can be. Regardless of who's in the White House, the principle of Fed independence should remain sacrosanct. The Federal Reserve's independence isn't just some boring economic principle, it's a critical firewall between your financial stability and political whims. So maybe, just maybe, we should leave monetary policy to the economists and not to whoever happens to be occupying the White House at the moment. As citizens and voters, understanding the reality is crucial because, in the end, the true measure of economic policy isn't how it performs until the next election. It's how it serves the long-term prosperity of its citizens. Thanks for watching. If you found this helpful, please subscribe and click the like button. It helps the channel enormously. And until the next time, ciao. Oh, and if you're interested in watching a more in-depth video on tariffs and how they affect American companies, click on the video on the side of your screen.